I worked in private banking for a number of years, and in this video I'll be going through how the rich use private banking to manage and increase their wealth. First, let's go through who qualifies for private banking. In general, a person needs to have at least $1 million in investable assets to qualify, but this threshold will vary at each private bank. These individuals are referred to as high net worth clients. The individual taking care of a client in a private bank is called a relationship manager. The relationship manager is responsible for meeting the client on a regular basis and having a deep understanding of their needs to offer the relevant products and services to them. The relationship manager will have a portfolio of clients to look after and would work with other relationship managers looking after a demographic of clients. These group of relationship managers form a desk, usually by region. So for example, you will have a Middle East desk focusing on clients from the Middle East, and usually the relationship manager who generates the most revenue would be the head of desk. Now let's go through the products and services private banks offer to their high net worth clients to understand how they benefit from private banking. The products and services that are offered can be broadly grouped into three categories. Category 1, traditional banking. Category 2, investment management. And Category 3, financial planning. Traditional banking includes checking and saving accounts, credit cards, lending services, and wholesale services. Your standard checking and saving accounts would offer higher interest rates due to the amount in the accounts. Due to the client's high net worth, credit cards being offered would have higher spending limits. And lending services usually focus on property purchases and capital for the businesses to grow. A lot of lending for property I have seen has been in exclusive areas like Park Lane and Mayfair, and as you can imagine, it's been for multiple millions. It also includes multiple £1 million renovations, and one person actually borrowed $1 million for a bathtub. So why borrow and not pay in cash? Well, there are a number of reasons. The rich would ideally like to use the interest they receive from their investments to pay for these purchases over time. This keeps their cash free for investment opportunities. Additionally, loans are not subject to tax, whereas using the income will mean paying of income tax on $1 million. I have included wholesale services to demonstrate many high net worth individuals like to keep their assets offshore. In other words, not in the country they are resident. The statements are kept at the private bank, and it is expected the client reviews these at least once every 2 years to ensure all transactions are legitimate. You would be surprised this does not occur in all cases. One client with a $10 million account was not coming to the private bank to review these transactions and was offered online banking for $10 a month. And surprisingly, they refused it, saying it's a waste of money. Investment management includes advisory portfolio management and discretionary portfolio management. Advisory portfolio management is where the relationship manager recommends investments to the client based on research and their risk profile. This is with the view of increasing their net worth. High net worth clients do make a good return during the boom and bust cycles. I remember in 2008 when share prices significantly dropped, high net worth individuals invested millions in shares, which resulted in them making a killing once the bailouts were announced, as the shares recovered and they sold them immediately. Discretionary portfolio management is where high net worth clients invest millions with a portfolio manager over a 3 to 5 year period. The portfolio manager will invest the money in line with the investment objectives and provide regular reporting so the relationship manager can inform the clients in their regular meetings. Financial planning. Financial planning includes tax services and estate planning. This is where the relationship manager will utilize a qualified financial planner to help the client implement tax efficient solutions. Estate planning is used to ensure the wealth is passed on in accordance to the wishes. One common method to use this is offshore trusts. The money is kept in these offshore trusts and distributions are made to those named in the trust in a tax efficient way. These trusts continue to be run in line with the agreement should the client pass away, ensuring those names in the trust are looked after. I recall one client with a 1.5 billion trust which guaranteed those named with approximately $300,000 of distributions on an annual basis for life. These were structured in a way to ensure they were not subject to tax when the individual received the money in their country of residence. Individuals were in different countries and each country needed a unique tax structure for these distributions to be made to ensure they were not subject to tax. We have gone through how the rich use private banking, and that is it for this video. Hope to see you in the next one.